Thank you, Eric, for that kind introduction. Now, as you can imagine, I was asked to come up with a title for my presentation somewhere in mid-December. So when I did, the title now is sounding a little bit too optimistic, perhaps. The idea that the world might be stagnant, maybe you're all worrying that it's crashing around us at the moment. And the idea of finding return, well, probably you're more worried at the moment about how to protect your capital than to find a return. So there's three things that I want to talk about today, in about 25 minutes or so to leave time for some questions at the end. The first is to give you an outlook for the economy and the markets over 2016. Now, what I will argue is that growth is going to be quite poor this year, probably worse than last year, but that we're going to avoid recession. Return from investments everywhere, I'm afraid, is also, I think, going to be quite poor. Secondly, I'll try to put that into a longer-term context. BCA is very much focused on long-term debt cycles, long-term growth drivers. It's very important, I think, in a world which is not something most of us experienced before, to have a roadmap. And one of my favorite sources of quotations about investment, or indeed about life in general, is a US baseball player called Yogi Berra. You may have come across him. He died a few months ago, in fact. And he said these things that sound, at first hearing, to be rather stupid, but when you think about them, are actually quite profound. And one of my favorite sayings of his is as follows. He said, "You've got to be very careful if you don't know where you're going, because you might not get there." So I'm going to try and give you a roadmap of how we're going to go over the next few years. And then thirdly, I want to be practical as well. So in this sort of world, how can you make money from your investments? Or at the very least, how can you avoid losing money? And my message will be you need to be cautious, but don't go all out defensive. If you want to make a return at all, you have to take a bit of risk in this sort of world. Now, this is probably the key chart for any investor. This is the return that you've got from the market over the past 30 years or so. So the last data point on here shows you that during 2015, measured at least in US dollar terms, and in Norwegian kroner would have looked a bit better, but in US dollar terms, you made a return of minus 2% from global equities. You made a return of 1% from global bonds. Zero, essentially, from everything. Even if you'd put your money in hedge funds, which are supposed to be uncorrelated to the market, last year the average hedge fund made minus 0.2%. It didn't help you. Now, there's a couple of key points from this chart. The first is, if you look at the equity returns, almost always they are better than bonds outside of recessions. So a key question that I'll try and answer today is, are we heading for a recession? If you look at the grey areas of this chart, which is the official definition of US recessions, you can see during those periods, of course, equities underperformed significantly. So what is the risk that the markets are telling us that we are heading this year for a recession? The second key message, I think, is if you go back to previous points ahead of a recession, the return that you got from cash or bonds was significantly better than you can get today. For example, if in 2007 you'd have been very smart, and maybe the Skagen guys noticed this, you'd be very smart and you noticed there's a big recession coming. If you'd have put your money in cash, you made 5% in US dollars in 2007. If you put your money in 10-year US bonds, you also made 5%, and you knew that yield was going to go down, so your total return would probably be 10%. If you do that today, you're lucky if you get zero from cash. 3 month German government bills give you minus 0.6, and the average return from government bonds is 1%. So the risk-free alternative is so much worse these days that I would suggest you must not dismiss equities completely. So what is the picture with the global economy? This one chart probably sums it up pretty well. This is the US ISM. It's probably the single best indicator, in my view, of where the global economy is going. And what you can see is a very surprising gap between manufacturing industry and the services industries. It's unusual for these two ISMs to move so far out of line. Pretty much never happened in the past. And it's not just in the US we see it, in Europe, in China as well. Manufacturing is in a slump. We're in an industrial recession. Industrial output is actually declining, but services are holding up very well. So what's the background to this? What's the cause of this? My argument would be that it is down to a big commodities shock that the world economy has faced in the last few years. Commodity prices are down by about 40% over the past 4 years. And that is caused by what economists call a hog cycle. Now, this was a phenomenon that economists noticed in the US in the 1920s. Hogs is a US word for pigs. And what happens, it's basic economics, is when the price of pork goes up, farmers try to find ways of producing more pork. It takes a few years to do that. You have to find a pregnant pig, the piglets are born, it takes 2 years or so to fatten the pig up. The cycle is about 3 years for pork. And just as that new supply is coming onto the market, very often demand is turning down. So supply increasing, demand turning down, you can imagine what happens to prices. Now that's exactly what has happened to commodities in the last few years. Chinese demand came through in the 2000s. With a lag, miners and oil companies reacted by increasing production, by spending more money on capex. That was delayed a bit by the global recession, but by 2011, the production was coming through just at the point where China was seeing a slowdown, seeing a shift towards services. And that's what's happened to that price. Now, this has reverberated through the global economy. Capex, capital expenditure, is very dependent on the commodities sectors. 30% of global capex is to the energy sector, about another 10% to the mining sector. So you've had a slowdown there. You've had a slowdown as well. You've had deflationary pressures, which has hurt profitability. It's washed its way through the global economy. And the question now is, does it come through and start to hurt services, start to hurt employment as well? But don't forget, there's some positives from this as well. Essentially, this decline in commodity prices represents a transfer of wealth from commodity producers to commodity users. For example, countries that don't have much in the way of natural resources. It also helps consumers. If you take the US, for example, the average price of gasoline has fallen from $4 a gallon a year ago to only about $2 a gallon now. Now, to put that into a number that means something to you, that's about 5 Norwegian kroner a litre, I calculate. And I hope that doesn't make you feel too jealous of us who live in North America. So it's very much a positive thing for consumers. It represents almost a tax cut for consumers. So if I now run through very quickly the main regions, what is happening in the economy. If you look at the US, consumption, personal consumption, expenditure has actually held up quite well. There are some signs it's beginning to pick up. There's the benefit of lower gasoline costs. Wages are starting to pick up a little bit as well. The unemployment rate in the US has now gone down to 5%, and even the so-called U6 underemployment has come below 10%. And historically, that's been the level at which wages start to pick up. So we're not very optimistic about US growth this year. It's unlikely to be as good as the 2.5% last year, but consumption is likely to hold up fairly well. If you look at Europe, the picture is also a little better than it was a couple of years ago. If you look at GDP, it has come off the bottom after the euro crisis in 2013. There's a very strong correlation in Europe between bank lending and GDP growth. And since the euro crisis, we've seen bank lending pick up a little bit. However, I would warn here too that bank loan growth does appear to be slowing a little bit. And therefore, the forecasts that most economists have, the IMF, for example, forecasts 1.9% GDP growth in Europe this year. We think that's probably a little bit too optimistic. So Europe's doing okay, but it's not really going to be the engine of global growth. And then Japan, the results of Abenomics still look a little patchy. It's not really coming through into the real economy. If you look at, for example, industrial production, growth has slowed to zero. Lead economic indicators in Japan have actually come back down over the last 6 months. And the big problem for Japan is that China is its biggest customer. And as we'll see in a second, the picture in China doesn't look great either. It's wrong to be too hard on Japan, though. And I put this chart in because it's one of my favorites for describing the way the world works. And it just reminds you of how important demographics are. So the top chart will be one that will look very familiar to most of you. GDP in nominal terms over the last 15 years, no big surprise. The US has done best. Europe has lagged a bit behind the US, and Japan has been terrible. GDP has not grown for 15, in fact, even for 25 years. But the entire reason for that comes down to demographics. In Japan, the workforce has shrunk from 87 million to 77 million over 15 years. It's a 10 million reduction in 15 years. So if you look at the bottom chart, which shows you output as a ratio of the population of working age, Japan actually looks the best of the three regions. So what can Abenomics really do faced with those headwinds of demographics? Frankly, not enough, not very much. And what about China? We're actually reaching a world now where the picture in China is probably more important than for any other region. And our view is that China will not have a hard landing. It's been in an industrial recession for 4 or 5 years. So that picture of service growth versus manufacturing growth is particularly clear in China. And the big difference with the US, for example, is that in China, manufacturing is more than 40% of GDP. In the US, it's only 12%. So it's starting in China to drag down services as well. Why we're a bit more optimistic is that the authorities do have a lot of tools at their disposal to deal with this problem. And we're already starting to see monetary conditions, the bottom number there, starting to pick up, starting to ease. The People's Bank has cut rates now 3 times, but the reserve requirement, for example, is still quite high. The budget deficit is only about 2.5% of GDP, so there's a lot that the Chinese can do to try and offset the slowdown. Now, the problems that have started this year have been to do with the currency, and that's one of the tools that the Chinese have now clearly started to use. The problem is that the authorities in China have been extremely poor at messaging, at telling us what they're trying to do. And the picture is actually, I think, rather clear. If you look at this blue line, what you can see is that over the course of the past 2 years, China has pegged the renminbi to the US dollar. And with the US dollar strength against everyone else, the picture of the renminbi against a trade-weighted basket is that you've seen significant appreciation, damaging the competitiveness of China. Since August last year, when you remember they devalued the renminbi by 2%, the currency has moved flat against a basket of currencies of its trading partners. Now, in December, they announced that basket, and it seems fairly clear to me that they're targeting the renminbi now against that basket. They've just been very bad at signaling to the market that that is what they're doing. Now, the risk is that the renminbi should fall further than that. The dynamics in China with a build-up in credit suggest it should weaken further. They've already spent, as you can see from the red line, 15% of their reserves, $500 billion last year, in propping the currency up. They've got 3.3 trillion left, but at some point do they say it would be healthier to have a one-off depreciation and decide overnight to bring the renminbi down 10%. That would be a major shock to markets. Finally, emerging markets. At BCA, we've been quite negative, been bearish on emerging markets for 4 years. And the picture really comes down to the debt dynamics. What happened was that after the global financial crisis in 07-08, the Fed eased policy. A lot of that liquidity went into the emerging markets, and we saw a huge pickup in debt. Credit in all of the major emerging markets was growing by more than 20% a year in 2010 to 2012. And what's scary is the level of emerging market debt as a percentage of global GDP is now higher than US debt as a percentage of global GDP at the peak of the housing crisis. So we think that debt is still a problem. The deleveraging process for emerging markets has only just begun. It's going to drag growth down further, means that emerging market currencies are going to weaken. This is clearly the biggest economic risk for markets this year. So am I being too optimistic in suggesting that growth is going to be weak, but we're not hitting a recession? Most of the indicators that we look at are not yet flashing recession. And this has been the most reliable indicator of recessions in history. It's the shape of the yield curve in the US, the difference between 10-year government bond yields and 2-year. And it's currently 2.2 versus 0.9. And you can see that historically, this gap, this shape has always turned negative ahead of a recession. So for it to happen this year, we would need to see the Fed raise rates, let's say 4 times, as they promised, to 1.4 or so, and for the 10-year to fall quite sharply. That's not impossible, but that's certainly not the scenario at the moment. So this is the roadmap I would look at for trying to see how markets work, what causes recessions. It's probably the single most important chart I've got in here. So the red line on here is the potential for output in the US. So if the economy was growing at full potential, full employment, companies were producing at full capacity, that's where GDP would be. And the black line is the actual output. And you can see what happens is, you take 1990, for example. In a recession, output slows, it picks up back to the trend line. But once it starts going above trend, that becomes inflationary. The central bank tightens rates, raises rates, and that often causes the next recession. Now, the last few years, growth has been a bit weak by historical standards, and that led a lot of people to say that's negative for equities. Actually, I would argue the last few years have been a sweet spot for equities. This picture of moderate growth, but a big negative output gap, which means that that growth was non-inflationary, is a perfect environment for risk assets because the central bank can have very accommodative monetary policy. Now, it looks to me, it's obviously very hard to measure potential output. It looks to me, though, as if we're still probably 2 or 3 years away from that gap closing. So as long as the Fed doesn't make a mistake, doesn't push ahead with raising rates when it's not justified, it should be the case that we have another 2 or 3 years left to go in this expansion. So let me move on to how you should invest and start with some of the key factors driving markets. So first of all, equities. And I'm sorry to say it's very hard to make a case for decent returns from equities this year. If you think about what drives the equity market, simply put, it's earnings growth and then the multiple, the P ratio that the market applies to that earnings growth. So if we start with the valuation, with the P ratio, unfortunately, markets everywhere look quite expensive. So this is the picture at the end of last year. The US market was on a forward PE of 17 times, which is the highest that it was at any time, apart from the peak of the tech bubble at the beginning of 2000. It's come down obviously a little bit, probably 16.5 times, still quite expensive. Europe looks a little cheaper, but the gap between Europe and the Eurozone is pretty similar to the historical average, and the returns that European companies make the ROE is a bit lower than the US. So I wouldn't argue that Europe's particularly cheap. And Japan is quite similar to Europe. It's cheaper than it was historically, but then in the 90s, it was ludicrously expensive. So valuations everywhere look a little expensive. And earnings, given the anemic outlook for growth, economic growth that I talked about, top-line sales growth is going to be quite poor this year. And in the US in particular, it looks as if margins are coming off, coming down. Wages are starting to rise. The cost of borrowing is going up. Tax rates are going up. It's very hard to argue that margins will not come down. Europe looks a little better, but even Europe's not going to see margins back to where they were in 2007. So that means to me earnings growth of 2 to 5% in the US is the best you can expect. Best you can expect is valuations flat. It's hard to see how you make a return from equities of anything other than low single digits. And most of the global strategists at investment banks on Wall Street are still looking for 10 to 12% upside for the market this year. That does seem to be pretty optimistic in my view. To skip through a few charts, just one I wanted to focus on though, which is a key factor for markets this year, is what happens to commodities. And this is probably the longest historical chart that I have in this presentation, 200 years of data. And what's interesting is if you look at commodity prices over the long run, relative to other prices, they clearly go down. So this is adjusted by the US GDP deflator. And when you think about it, that's actually quite reasonable. Humans find ways to dig metals out of the ground or to mine to drill for oil more cheaply, more efficiently in the past, and we get better at using these products more efficiently. And there's a saying I very much like, which is that to be long commodities is the equivalent of being short human ingenuity. So in the long run, commodity prices fall. We have super cycles occasionally, like the 1970s and like the last few years. But our view is that super cycle is over, and commodity prices currently are still quite high compared to that long-run channel. So we believe commodity prices have got quite a lot further to fall. The oil price, which you'll be interested in here, we're a bit less negative on. We see supply and demand rebalancing perhaps by the third quarter of this year. Quite how much oil falls in the meantime is hard to forecast, but we're a little bit more optimistic on oil than we would be on some of the metals. So 3 things I'm going to suggest as practical ways of investing this year. First of all is avoid the temptation to think that emerging markets are cheap. In our view, emerging markets still should be avoided. It's very easy to say that after 4 or 5 years of underperformance, this is the time to go back in. Valuations are not generally cheap. If you look at the median share price for emerging markets, it's very similar to that for the developed markets. The problem in EM is that the stocks that are cheap are the ones you really don't want to own. They're Chinese banks or Russian oil companies. And the stocks you do want to own, consumer names maybe, or maybe countries like India and Mexico, are very expensive. And secondly, this deleveraging process I talked about has got a long way further to go. You'd expect to see bad debts come through at some point, and the non-performing loan ratio of emerging market banks has only just started to pick up. There's room for a big credit crunch, credit crisis in EM this year. The second practical suggestion, this is a more controversial one, even amongst my colleagues at BCA, is that the best way, I think, to get yields this year, or the best risk-return trade-off, is actually in US high-yield debt. That's now yielding 9%. Now, obviously, that's partly because of the energy sector, but energy is only about 1/10 of all high-yield debt. So compared to equities, which look expensive as we saw, this looks relatively cheap, even if defaults go up, as long as we don't have a recession. And thirdly, US equities, in my view, offer a better risk-reward trade-off than Europe does. And that's really because in a risky environment, when you're looking to get some exposure to equities, but to limit your downside, the fact that US equities have lower volatility, to me, is attractive. In a downturn, in a bear market, you're going to lose a lot less money in the US than you are in Europe, where equities are much more cyclical. So let me finish with a couple of conclusions. I'm afraid to say I think it's going to be hard to make any better returns this year than last. You need to be quite nimble. You might think about trading in and out a little bit. And one rule of thumb, I think, is to be looking to sell US stocks when the S&P 500 is at 2100 and to buy them when it's at 1900. After the last 10 days, it's got down to 1920. We might actually be looking for an opportunity for a short-term buy at the moment. I think the global expansion has probably got a couple of years still to go. But the one thing that I would point out is that when we do hit the next recession, and they will happen at some point, it's going to be a very tricky one. The authorities have run out of ammunition. There's no room to use fiscal policy and very little room to use monetary policy if we go into a recession with rates at 0. So that recession when it comes, could be a really very nasty one. So on that cheerful note, I thank you for your attention. We've got a few minutes left for questions, if you have some. Thank you very much.
Thank you, Garry, for sharing those insights with us. If there are any questions from the audience, I have a couple here. Please do write them on the cards and pass them along to the Skagen employees. So first question, you mentioned emerging markets here, and not still the time to get in. And for us as emerging market investors, we've all come to learn that BRIC, as some of you heard before, is not really about Brazil, Russia, India, and China. It's bloody, ridiculous investment concept. Clearly the case for the past 4 or 5 years. But my question is, what would you look for in terms of signposts to try to spot a turnaround in emerging markets? Are there any particular factors that investors should pay attention to?
There's a few that spring to mind. I mean, one is commodity exposure. So you want to avoid the commodity producers and buy the commodity users. So generally, Brazil and Russia you avoid amongst the BRICS. Amongst the smaller ones, Indonesia you'd avoid. India probably looks the most interesting. Second would be structural change. What I think has happened in emerging markets has been a lack of structural reform. So if you go back to the 90s, India reformed, Brazil reformed. They then rested on their laurels. They've been complacent. So any signs that that is happening, again, India ticks that box, Mexico does, but does Brazil? I don't think so. Does Russia? I don't think so. So I think that's an issue. And the third would be the fundamentals of the economy. So if you're running a large current account deficit, that's a worry. If your banks have gone out and borrowed a lot in foreign currencies, that's a worry. If your central bank is printing money, weakening the currency, that's a worry. So within EM, India, Mexico, possibly parts of Korea and Taiwan look interesting. Russia, Turkey, Brazil, Indonesia look the most risky.
Yes, we have a question here which asks, what about illiquid asset classes such as private equity, private debt, infrastructure, and so on, given the scenarios you just outlined?
So in general, I would favor those to a degree. What you get by putting your money in those is an illiquidity premium. So it's a little bit like when you put your money in a bank, you typically get a higher deposit, maybe not these days, but a higher rate on your deposit for locking your money up for 5 years than you do for putting it on just a current account. So if you're willing to go into private equity, the money's locked up for 5 to 10 years, you should expect to get rewarded from that. Having said that, however, most of those illiquid assets also represent similar risk factors to public assets. So if you're buying private equity, the historical evidence, academic work shows you that the set of risks you're taking is actually pretty similar to buying public equity. Where there are some interest perhaps is in alternative asset classes. I think people increasingly are looking at credit, concept of private credit, like private equity. In Europe in particular, with banks facing constrained capital requirements, stricter capital ratios, they're lending a lot less. So if you're an institution that can take that sort of liquidity risk, being in credit markets might help. I also hear a lot of institutions increasingly looking at peer-to-peer lending. I think there's risks in that. You need to do your work to analyze it, but potentially, again, you're stepping into a place where banks have had to step back. Real estate, I would be less optimistic about. I think that's much more driven by global cyclical characteristics like public equities are. And with Chinese and Russian purchases of commercial and residential real estate likely to decline quite sharply, there's quite a lot of risks in that market as well. So it's somewhere where you have to do your homework and you have to recognize that premium you're getting, you're paying through the illiquidity. You can't get hold of your money.
Any further questions from the audience? Feel free to raise your hand. I think there's one down there. No. Thank you. So, Japan was the best market in 2015 and the only market with EPS upgrades despite a stronger yen. What's your outlook for that market?
So I did actually skip over the page on Japan to leave. So I'm not a huge enthusiast for Japan. We have an overweight on it. I do think it will continue to outperform this year. Abenomics, as I suggested in the presentation, I don't really think is working. And to some extent, that is actually why I would be positive on Japan this year, that the 2% inflation target, they are far away from achieving. So inflation currently is running at 0.1%, and they're supposed to hit 2% by the end of March next year. So I think what will happen is in the second half, the Bank of Japan will realize it's nowhere near its target and will do more monetary easing. And they can't just buy more Japanese government bonds. They already own about 40% of that market. At their current rate, they're going to own 60%. So they're going to have to increase their purchases of ETFs, equity ETFs. And currently, they're buying about the equivalent of 0.5% of market cap a year. If they start to push that up significantly, that could be a major impact on the Japanese market. So forget growth, forget whether corporate governance is really changing, all those things. I think just the fact that BOJ will be the only central bank out there significantly increasing QE does make Japan, in a difficult world, look like an interesting equity market to be in.
Great. Well, I'd like to thank Garry Evans very much for his contribution. So give him a big round of applause.
Thank you very much.